Warren Buffett just sold over $4.35 billion in stocks, including a complete exit from Citigroup and new holdings totaling over $1.5 billion. But here's the twist. He isn't calling for a market crash or panicking like many investors might expect. Instead, Buffett's moves are sending a signal that there's something deeper going on beneath the surface. What does he see that most people miss? Stick around to uncover the critical red flags Buffett spotted, how his strategy can help you protect your portfolio, and position yourself for Buffett's next big move. There's more to this story than just a headline sale. When Warren Buffett decides to sell over $4.35 billion in stocks, it's not just a headline. It's a signal that something important is happening beneath the surface. Moves of this magnitude from an investor of his stature tend to ripple through the entire market. But it's not only the size of the sale that stands out. The specific companies Buffett targeted reveal a lot about his thinking. Take Citigroup, for instance. Buffett's complete exit meant selling all 14.66 million shares, a sale worth about $1.1 billion. That's a huge shift, especially considering that he originally bought in during a downturn in 2022, hoping for a turnaround. But Citigroup's return on equity has hovered at just 6%, which means for every $100 of equity, the bank earns only 6%. That's far below what you'd see from stronger peers like JP Morgan. And it's clear why Buffett decided Citigroup no longer fit his standards. New Holdings, a Brazilian digital bank, was another major divestment. Buffett sold all 40 million shares, collecting around $482 million. New Holdings had the hype, explosive user growth, and the promise of fintech innovation in Latin America. But growth didn't translate into sustainable profits. Operating income stalled, losses continued, and the macro environment in key markets like Brazil and Mexico was anything but stable, with high inflation and volatile interest rates. At the time of sale, New Holdings traded at a forward price-to-earnings ratio of about 24.3 times, higher than traditional banks and still elevated for a fintech in emerging markets. That kind of premium valuation, combined with unpredictable conditions, made it a riskier bet than Buffett was willing to hold. Then there's Bank of America. Unlike the other two, Buffett didn't exit completely, but trimmed his position by 48.6 million shares, worth about $2.1 billion. He still holds a substantial stake, but this reduction signals a shift in his confidence. The banking sector has benefited from rising interest rates in recent years, boosting net interest margins. But as that tailwind fades, banks face tightening margins and growing concerns over consumer loan quality and commercial real estate exposure. These are real risks that could weigh on future performance, something Buffett doesn't ignore. Looking at these moves together, you can see a pattern. Buffett isn't just reacting to short-term price swings. He's responding to deeper structural issues at each company. Citigroup's persistent inefficiency and low returns, New Holdings' struggle to turn growth into profit in a tough environment, and Bank of America's exposure to sector-wide risks all point to businesses that no longer meet the high bar Buffett sets. When he sells, it's usually because the business has changed in a way that undermines its long-term potential. This approach is classic Buffett. He's not interested in chasing trends or making emotional decisions. Instead, he uses a strict, consistent framework to evaluate his investments. If a company can't deliver strong returns on equity, maintain operational efficiency, or navigate changing market conditions, he moves on. The timing of these sales is especially telling. Buffett is known for his patience and discipline, so when he makes a move of this scale, it's a calculated response to shifting risks and valuations. But these sales are only half the story. Buffett redeployed that cash in surprising places. Stay tuned. How does Warren Buffett know when it's time to pull the plug on an investment? It's not instinct, and it's definitely not about chasing market trends. To understand how Buffett decides to exit an investment, you have to look at the specific red flags he watches for, signals that tell him a business is no longer a fit for his portfolio. These aren't just gut feelings or reactions to headlines. They're rooted in hard numbers and clear trends. Buffett's discipline means he'll walk away from even a long-held position if the fundamentals no longer stack up. Start with Citigroup. Buffett's exit wasn't about short-term volatility. It was about the bank's inability to generate strong returns compared to its peers. Citigroup's return on equity hovered around 6%, lagging far behind competitors like JP Morgan, which consistently post much higher numbers. That gap signals more than just a bad quarter. It points to underlying problems in how the business is managed. On top of that, Citigroup struggled with deep operational inefficiencies. Its costs were simply too high relative to its revenue, making it hard to justify holding on for the long run. For Buffett, these numbers matter. He wants to see efficient use of capital and strong, consistent profitability. When a company falls short, it's a clear warning sign. Growth potential is another area where Buffett pays close attention. New Holdings looked like a breakout story in the fintech world, especially with its rapid user growth across Latin America. But Buffett doesn't just chase growth for growth's sake. He digs into the numbers to see if that growth actually leads to sustainable profits. In New Holdings' case, operating income stalled, and high inflation in Brazil and Mexico squeezed margins. The company was still posting losses, making its future uncertain. At 24.3 times forward earnings, New Holdings priced itself as if risk was non-existent. Buffett sees real markets differently. He knows that when a business is valued for perfection but faces mounting challenges, the downside risk grows. That's not a bet he's willing to make. Even companies that have performed well for years can end up on the chopping block if conditions change. Take Bank of America. Buffett trimmed his position by $2.1 billion, not because he lost faith in the business entirely, but because the risk-reward equation shifted. With rate-driven margins fading and rising credit risks, Buffett locked in gains. He recognized that the bank's ability to deliver strong, reliable profits was under pressure. For him, it's not about loyalty. It's about whether the business can keep compounding value going forward. Valuation always plays a central role in Buffett's thinking. He's made it clear that when a stock trades well above its intrinsic value, the real underlying worth of the business, it's time to reassess. Citigroup's weak profitability and New Holdings' price tag relative to uncertain profits both triggered this alarm. Even Bank of America, despite its strengths, became less attractive as sector risks increased and upside potential shrank. So next time you see a stock trading above its intrinsic worth, ask, is this story really this bulletproof, or am I just overpaying? Buffett's approach isn't about chasing hype. It's about protecting capital and seeking real value. But the red flags Buffett watches for aren't always obvious. Sometimes it's subtle shifts, rising costs, slow growth, or creeping inefficiencies that signal a business is losing its edge. Buffett's success comes from spotting these warning signs early and acting before problems become obvious to everyone else. He's not afraid to let go of a stock if the fundamentals don't justify the price, no matter how popular or familiar it might be. This disciplined mindset is something any investor can apply. Instead of holding onto an underperforming stock out of habit or hope, take a step back and ask the tough questions. Is the company managing its resources well? Are profits growing or just the hype? Does the current price truly reflect the business's long-term prospects? Buffett's method reminds us that the goal isn't to collect stocks, but to build wealth by owning businesses that consistently deliver. And while identifying red flags is crucial, what Buffett does after selling is just as important. His next moves reveal where he sees the best opportunities, a side of the equation that offers its own set of lessons for anyone looking to invest with confidence, even when the market feels uncertain. When Buffett redeploys billions after a major sale, he's not just shifting money, he's signaling exactly what he values in an unpredictable market. His biggest Q1 2025 purchase was Constellation Brands, recession-resistant alcohol sales, and a 34% beer operating margin made it Buffett's top buy at $1.17 billion. This company owns Corona, Modelo, and other leading beverage brands, and it has a proven ability to keep sales steady even when consumers cut back elsewhere. Buffett's choice here isn't about chasing what's popular, it's about prioritizing businesses with reliable demand, efficient operations, and brand strength. Constellation also trades at a price-to-earnings ratio of 14, which is low for its sector and signals that Buffett is still laser-focused on finding value, not hype. The same logic applies to his moves in energy. Buffett increased Berkshire's stake in Occidental Petroleum by 763,000 shares, bringing the total to nearly 28%. Occidental generated over $4 billion in free cash flow last year, free cash flow Buffett uses to pay down debt, and that discipline is a blueprint you can apply. Look for companies that self-fund growth. Occidental's management has prioritized reducing leverage and maintaining a strong balance sheet, which is especially important in a sector known for volatility. Buffett isn't betting on a short-term spike in oil prices. He's betting on a business that can weather cycles, control its costs, and reward shareholders over time. On the surface, satellite radio looks outdated, but Buffett zeroed in on its $1 billion in subscription cash flow in shares of SiriusXM for $58.8 million, even as streaming dominates headlines. SiriusXM's strength is its high-margin, subscription-based revenue, which tends to be stable regardless of broader economic swings. Buffett's history is filled with similar moves, buying into businesses that generate consistent profits, even when they're not considered cutting edge. He understands that steady cash flow and loyal customers can be more valuable than chasing the latest trend. If you look at the rest of Buffett's Q1 2025 purchases, Domino's Pizza, PoolCorp, and others, the pattern is clear. He's consistently picking companies with predictable cash flow, market leadership, and valuations that leave room for growth. None of these are momentum-driven or speculative bets. Instead, they operate in sectors where demand is steady and management has a track record of delivering results. Buffett's approach avoids getting swept up in hype and focuses on the core fundamentals that drive lasting returns. Contrast that with the kinds of companies Buffett is steering clear of right now. He's not interested in high-growth, high-risk ventures that rely on future potential rather than current performance. While some investors are drawn to the next big thing, AI, speculative tech, or emerging markets, Buffett's portfolio is built for resilience. He's looking for businesses that thrive in all conditions, not just during boom times. That means prioritizing earnings stability, operational efficiency, and fair valuations over chasing the crowd. These decisions say a lot about how Buffett sees the current market. He's positioning away from sectors vulnerable to economic swings and toward companies that can keep generating cash even if the economy slows down. His investments show a preference for durability over excitement and for value over momentum. For investors watching his moves, the lesson is clear. You don't have to gamble on uncertain trends to find opportunities. Instead, focus on businesses with strong fundamentals and a history of managing through tough times. Buffett's reinvestments aren't just about individual stock picks. They're a window into his broader strategy for navigating uncertainty. But studying where he puts his money, you get a first-hand look at how to balance caution with opportunity. So what do Buffett's moves tell us about where the market might be headed? That's the billion-dollar question, and understanding his approach could change how you think about your own portfolio. Buffett's contrasting moves signal where real value lies right now. When you look at his recent portfolio changes, you see a clear pattern. He's pulling back from financials and telecoms, industries that live and die by stable interest margins and strong economic growth, and redirecting capital toward businesses that generate dependable cash, no matter what the market throws at them. This shift isn't subtle. By exiting Citigroup completely and trimming his Bank of America stake, Buffett is signaling that he sees more risk than reward in sectors exposed to consumer credit and commercial real estate. These are areas where even small changes in economic conditions can have a big impact. Instead of betting on a quick rebound, he's opting for safety and consistency. It's a reminder that sometimes the smartest move is to step away from uncertainty, especially when the signals point to trouble ahead. On the other hand, his biggest new investments are in industries with built-in resilience. Alcohol holds up under stress. Buffett's beverage isn't about glamour, it's about reliable revenue. Constellation Brands, for instance, produces products people keep buying even when times are tough, and their steady cash flow is exactly what Buffett wants in a shaky economy. He's not looking for the next big thing. He's looking for the next safe thing. Energy is another area where Buffett is doubling down, but not just any energy company will do. His increased position in Occidental Petroleum is a bet on financial discipline. Occidental generates billions in free cash flow and uses that money to pay down debt, not chase risky expansion. In a world where capital is getting more expensive and investors are wary of debt, this kind of approach stands out. Buffett's strategy here is simple. Find businesses that don't just survive market swings, but use them as opportunities to strengthen their balance sheets. Emerging market fintechs might look exciting on paper, but Buffett's actions tell a different story. High inflation and unstable rates in Brazil and Mexico forced Buffett to reassess new holdings. He recognized that, despite rapid user growth, the company's profits weren't keeping up, and the risks tied to those economies were only getting bigger. By pulling out, Buffett sidestepped the volatility that often comes with betting on regions where economic conditions can change overnight. While others chase hype, Buffett sticks to metrics you can measure: cash flow per share, manageable debt, and a margin of safety. He's not interested in the hottest trends or the fastest growing stocks if the fundamentals don't add up. This is why you'll see him buying into companies like SiriusXM. It's not flashy, but it delivers consistent, high-margin subscription revenue. That kind of predictability is worth more to Buffett than any story about future potential. This disciplined approach is especially important in an environment where inflation is stabilizing but growth is uncertain. Buffett's moves show that you don't have to predict every twist in the market to succeed. Instead, you adapt to what's in front of you, selling businesses when valuations get stretched or risks mount, and buying into companies with proven durability and real value. He's not making bold predictions, he's making careful adjustments, always with an eye on long-term results. For individual investors, the lesson is clear. Discipline beats speculation. You don't need billions to apply Buffett's strategy. Focus on companies with steady cash flow, strong brands, and manageable debt. Ask yourself, does this business have what it takes to ride out a downturn? Are the profits real and repeatable, or just a product of good luck? What business in your portfolio checks these boxes? Pause the video and think of one. Buffett's recent moves aren't about reacting to fear. They're about applying a strategy that works across cycles. By focusing on what's durable and undervalued, he positions himself to succeed no matter what the headlines say. That mindset can help anyone at any scale make smarter choices when markets get choppy. Buffett's recent $4.35 billion in sales highlight the value of strategic capital allocation. He isn't selling out of fear, but rather repositioning based on changing fundamentals and valuations. By stepping away from businesses that no longer meet his standards, Buffett demonstrates that discipline, especially in deciding when to sell, is just as important as knowing when to buy. The next time you're considering an investment decision, ask yourself, does this idea fit Buffett's criteria of durable cash flow and fair valuation? Investing isn't a race. If you found these insights helpful, hit like and subscribe to get weekly breakdowns of Buffett-level moves. Subscribe for more of the strategies top investors use to build lasting wealth.